The Iran war is continuing to transform global oil markets, and China's Sinopec, the world's largest refiner, is making one of its biggest supply shifts in recent years. Facing severe disruptions to Middle Eastern crude supplies, the company has significantly increased purchases of Russian Far East oil, signaling how the conflict is reshaping international energy trade and refinery operations. Between July and September 2026, Sinopec secured between 30 and 40 Russian cargoes for delivery. In July alone, it purchased around 7.4 million barrels of ESPO, or Eastern Siberia Pacific Ocean crude. For both August and September, the refiner booked at least 10 cargoes each month. Rather than expanding imports from multiple regions, Sinopec has prioritized Russian Far East barrels because they offer greater delivery certainty, lower freight costs, and quicker transport compared with longer-haul alternatives. The company has also drawn on onshore crude inventories to help maintain stable refinery operations. The change is even more striking when compared with Sinopec's previous dependence on the Middle East. Before the Iran war, almost half of its crude came from the region, with Saudi Arabia supplying an average of 11 million barrels each month. However, Sinopec imported no Saudi crude in June or July 2026. In August, imports recovered to only 2 million barrels, a sharp drop from the roughly 20 million barrels received as recently as March and April. Economics have reinforced the shift. Russian ESPO crude is trading at discounts of $1 to $2 per barrel against the Brent benchmark, making it about $10 cheaper than competing grades such as Middle Eastern Oman or Brazil's 2P. These lower costs have helped Sinopec preserve refining margins and stable throughput, even as China has limited overall fuel exports to protect domestic supply. Meanwhile, overall Chinese crude imports fell 41% year-on-year in June after the Iran war began. To navigate U.S. sanctions on Russian producers, Sinopec has relied on intermediaries and settled purchases in Chinese yuan, while continuing to expand Russian imports as Middle Eastern supplies remain constrained.